Are you invested in index funds? You might be sitting on a ticking time bomb without even knowing it. In this video, we'll uncover the shocking truth about the index fund problem that could explode in 2024 and potentially wipe out billions in investor wealth. Buckle up, because what you're about to learn might change the way you think about investing forever. Hey there, finance enthusiasts! Welcome back to our channel. Today, we're diving deep into a topic that's been keeping Wall Street insiders up at night: the looming index fund problem that could rock the financial world in 2024. Now, before we get started, let's take a moment to appreciate how popular index funds have become. I mean, who doesn't love the idea of effortlessly riding the market wave to financial freedom, right? It's like the investing equivalent of a set-it-and-forget-it rotisserie chicken. Sounds too good to be true, doesn't it? Well, grab your favorite beverage and get comfortable, because we're about to unpack why this seemingly foolproof strategy might be leading us straight into the mother of all market bubbles. Let's start with some mind-blowing numbers. Did you know that in 2022, passive funds accounted for a whopping 16% of the US stock market's total value? That's over $8 trillion, folks. To put that into perspective, it's like every single person on Earth chipping in $1,000. Now that's what I call a crowdfunding campaign gone wild. But here's where things get really interesting. And by interesting, I mean potentially terrifying. The S&P 500, which is basically the poster child of index investing, has become increasingly top-heavy. We're talking about a financial Jenga tower here, with just a handful of tech giants holding up the entire structure. Enter the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These tech behemoths now make up over 32% of the S&P 500. That's right, nearly a third of the index is riding on just 7 companies. It's like putting all your eggs in one basket and then putting that basket on a roller coaster. Thrilling? Sure. Safe? Well, that's what we're here to discuss. Now, I can almost hear some of you thinking, but wait, these are great companies. What could possibly go wrong? Well, my friends, let me introduce you to a little thing called valuation. You see, when everyone and their grandma is buying these stocks through index funds, regardless of their actual worth, we enter dangerous territory. Imagine you're at an auction, and everyone keeps bidding higher and higher on a painting, not because they've suddenly become art connoisseurs, but simply because everyone else is doing it. That's essentially what's happening with these mega-cap tech stocks. The price keeps going up, divorced from the underlying value of the companies. But here's where it gets really scary. What happens if and when this tech bubble pops? Let's say there's a major AI setback or regulatory crackdown. Suddenly, those shiny tech stocks don't look so appealing anymore. With the Magnificent Seven making up such a huge chunk of the S&P 500, we could be looking at a potential 16% drop in the index overnight. And that, my friends, is the recipe for a market crash. It's like watching a house of cards wobble in slow motion, fascinating but terrifying. Now you might be thinking, okay, but surely all those passive investors will just ride it out, right? Well, that's where human psychology comes into play. You see, when people start seeing their hard-earned savings evaporate, panic sets in. And panic, my friends, is the mortal enemy of rational investing. Let's take a closer look at how this could play out. Imagine you're a typical index fund investor. You've been diligently putting money into your S&P 500 fund every month, watching it grow steadily over the years. Life is good. Then suddenly, boom! The tech bubble bursts, and your portfolio takes a nosedive. What do? If you're like most people, you might be tempted to hit that sell button faster than you can say market crash. And therein lies the problem. When millions of passive investors decide to jump ship at the same time, it creates a tsunami of selling pressure that could send the market into a death spiral. But wait, there's more. Remember how we talked about those mega-cap tech stocks making up a huge portion of the index? Well, when passive investors sell their index funds, it forces the fund managers to sell those stocks in equal proportion. This means that even if a company like Apple or Microsoft is still fundamentally strong, their stock could get hammered simply because they're part of the index. It's like being the straight A student who gets detention because the whole class misbehaved. Not exactly fair, is it? Now, I know what some of you skeptics out there are thinking, but most trading in passive funds happens on the secondary market, right? Surely that mitigates the risk. Well, you're not wrong, but you're not entirely right either. Yes, it's true that a lot of the trading activity in ETFs and index funds occurs between investors on exchanges rather than directly with the fund itself. This does help to reduce the impact on the underlying stocks to some extent. But here's the catch. When there's a significant imbalance between buyers and sellers, authorized participants step in to create or redeem ETF shares, which does involve trading the underlying stocks. So while the day-to-day fluctuations might not cause too much trouble, a mass exodus from passive funds could still create significant pressure on the market. But let's take a step back for a moment and look at the bigger picture. Is this passive investing bubble inevitable? Are we all doomed to watch our index fund investments go up in flames? Not necessarily. You see, unlike the dot-com bubble of the late 90s, today's tech giants are actually making money, and lots of it. Their earnings have been growing along with their stock prices, which does provide some fundamental support for their valuations. However, and this is a big however, the concentration risk is still very real. When a third of the S&P 500 is made up of tech stocks, it doesn't take a financial genius to see that we're putting a lot of eggs in one sector basket. So, what's an investor to do in the face of this looming index fund problem? Well, I'm not here to give financial advice, but I can suggest a few things to consider. 1. Diversification. Yes, it's an investing cliche, but it's a cliche for a reason. Consider spreading your investments beyond just S&P 500 index funds. Look into other asset classes, sectors, and geographic regions. 2. Active management. While passive investing has its merits, there might be a case for incorporating some actively managed funds or individual stock picks into your portfolio. Just be sure to do your research. 3. Stay informed. Keep an eye on market trends and be aware of the risks in your portfolio. Knowledge is power, especially in the world of investing. 4. Have a plan. Decide in advance how you'll react to market volatility. Having a solid investment plan can help you avoid making emotional decisions in the heat of the moment. 5. Consider rebalancing. Regularly adjusting your portfolio to maintain your desired asset allocation can help manage risk and potentially improve returns over time. Remember, the key to successful investing isn't about predicting the future, it's about being prepared for different scenarios and staying level-headed when others are losing their cool. As we wrap up this deep dive into the potential index fund problem of 2024, I want to hear from you. What do you think about this passive investing bubble? Are you concerned about the concentration of tech stocks in the S&P 500? How are you preparing your portfolio for potential market turbulence? Drop your thoughts in the comments below. I always love hearing your perspectives and insights. And hey, if you found this video helpful, don't forget to smash that like button, hit subscribe, and ring that notification bell so you never miss out on our latest financial tips.